Good afternoon, ladies and gentlemen. My name is Steve Gardner. I'm the Managing Director of Healthcare World, and welcome to this, our session at the Healthcare World Festival on funding the digital health revolution. Today's session is one that I'm really excited about, because for the last few years, I've lost count of the number of times that I've been sitting in rooms either with digital health entrepreneurs with fantastic ideas who are struggling to find the capital and the funding to make them happen, or conversely with investors who sit there and tell me that they've got money burning holes in their pockets and they can't find the right opportunities. As somebody who isn't an investment professional and doesn't profess for one moment to be an expert on why or how these deals come together, these organizations find each other and how these things happen, it's always fascinated me to try and understand from a layman's perspective what goes into creating these partnerships, opportunities and deals to fund what ultimately is the future of our healthcare globally. So to that end, I wanted to bring both sides of that debate together, to bring together investors and investees to talk about how do digital health deals come together? How do investors look for, triage, understand what they want from an investee, and actually what do the companies need from the investor? Is it just about money, or is it about more than money? Is there such a thing as good and bad money? To help me to answer all of these questions and many more, we've got an absolutely fantastic panel today, as I say, from both sides of the coin. So let me introduce some of them to you, well, all of them to you. So we have David Foreman, who is the Managing Director and Founder of Pretoria Ventures. We have John McKinley, Founder and Director of Coldwell Capital. David Horn, Founder of Funding Focus. Sarah Fox from Wyndham Venture Partners. Jason Helgeson, who is CEO and Founder of Helgeson Solutions Group, and is often in the middle of some of these conversations, particularly when it relates to US organisations. Mark Molnar is another individual from the investor side, from Funding Nav, and we've got some really interesting entrepreneurs as well. Elliot Angers, who is a friend of Healthcare World and is always good value on these in these conversations, CEO and co-founder of Infinity Health. Himanshu Kataria from CanCertain. I hope you get to hear about what his company does, because it's really exciting. And Romano Toscano, who is CEO and founder of Viascore. We also have with us today Heather Ann Hubble from Fundex. Fundex is a platform which brings together both the investors and the investees. So a little bit like me, she's probably sitting on the fence. So without further ado, what I'd like to do, I've asked the panel to provide me with a series of statements, views, if you like, from the investor-investee relationships from the front line of that particular conversation. What I'm going to do is I'm going to read out those comments, and then I'm going to ask the panel to debate them for 10 minutes each. We've got to finish at 12:30. Audience, and those of you watching on our website, you'll see the big red button that says ask a question. Please use it indiscriminately. Type in your questions for the panel and or comments, and I'll try and pose them. But let's get straight to the first point that we want to make. So Mona Hyatt from Nexus, what are investors really looking for, and why is that often not clear? Give us a perspective on that question then, Mona. Why is that vexing you?
Yes, certainly. Thank you very much, Steve. Good morning, everyone. So from our point of view, as a company, we're in our second round of funding. So we're very well versed with dealing with exactly what the specifications are from the investors who we have dialogue with. However, what we found over time is that it's becoming less and less clear. So we're very willing and we're very capable of handing over as much information that's required of us. And often it's information that is carved out in many different ways. And it's often the same information carved out in many different ways. But we get to a certain point down the line, and this could be several meetings in, where additional expectations are then placed upon us. For example, well, of course, we only work and invest in companies who are going to be revenue generating £1 million within the first month. And this is new information. And so what we want to know is, why is it becoming less and less clear?
So which of our brave investors would like to field that one? I'm not seeing any hands raising here. So if somebody, so well, David Foreman, in fact, thank you for being brave and taking this one on.
I think the honest answer to that is because the VC industry doesn't do it very well. They don't. I think there's the biggest thing that a VC needs to do is find and back exceptional companies and founders. And one of the ways to do that is spread your net really wide so you can meet loads of people and then sort of go through it. The other thing is, I think on that basis, it's a case of like spread your net really wide, you meet loads and loads of people, and then you can decide which ones you like. The other side of that is that I think VCs are slightly arrogant, slightly forgetting that the founders are their customers, and think that the founders are lucky to be on the bus of the VC and not the other way around, which is the VCs are lucky to be on the bus of great founders. So I think there's a power imbalance because VCs have money, founders want money and need it for investment. So that creates a sort of a little bit of an arrogance, a lack of caring, a forgetfulness that founders are customers. And that leads to all of these confusions and annoying things because from Mona's perspective, she thinks she's speaking to investors who want to invest in the type of business that Mona's building. She goes through the process, they have lots of lovely conversations, and then suddenly it's like, well, why aren't you doing $1 million of revenue at this stage? And it's like, well, we've never been doing $1 million of revenue from when we started. We've never told you we're going to do $1 million of revenue. If that's your criteria, why on earth have you not told us that? That's really frustrating for a founder, right? But the answer is because the VC industry isn't very good at caring for founders. And there's there's nothing more complicated or less complicated than that. People forget that founders are the customer.
David Horn, you wanted to comment on this one.
Yes. So, I mean, I agree completely with everything that the other David said. And looking at it from the perspective of someone who used to work with founders on fundraising and is now raising a fund myself, one of the key things that I've always found frustrating is, you go onto a VC's website, and depending on which VC it is, there might be a little bit of information. There might not be anything at all. There might simply be a landing page without even a "here's how you get in touch with us" button. Or sometimes there's if you're a founder, upload your deck here, and then kind of nothing happens for 4, 6, 8 weeks. So I think I think the problem is that the VC industry doesn't have a lot of incentive to change. They're doing very well. They're making tons of money. So it's working for them. But it's absolutely not serving the founders community the way that it could. And I think, there are some VCs that have great information on their website, and there are other ones that, quite frankly, I mean, it's appalling. Literally it's a landing page with nothing.
David, yeah, go.
Let me just jump in on that because David's hit a nail on the head there. So websites are poor, don't tell you why they're doing. The other thing that VCs do, and you see this a lot on LinkedIn, is moan about the fact that lots of founders come and approach them despite them being a business that isn't what that fund invests in. So VCs will tell founders till they're blue in the face, go to VCs who want to invest in a business that looks like the kind of thing you're building, but they're not actually do the job of telling people what they want to invest in. And it's just laziness. There's no reason for a website not to be it. The other reason for it is because so many VCs still have this outdated model of the best way of contacting us is through our representatives or our chosen partners or our whatever. And then VCs moan about lack of diversity in their portfolio. But if you are a bunch of white, middle-aged, well-educated guys who've all been to Oxford and Cambridge, and your mates are all the same, how on earth does how does your network find people who don't look and sound and talk like you? The only way to do that and democratize it is for people to have websites that tell people what they want to invest in, that are very clear on their investment criteria, and to have an open dialogue with every founder who looks and sounds like the business they're building is something like that. Whereas at the moment, you've got this closed shop of old boys who are doing very, very well, very little incentive to change, who want their mates to introduce deals to them because it's pre-vetted by their mates, and therefore it's less work for them to do as a VC. And I'm sorry, I am a VC, but I think our industry's pretty shit.
I think
language, Timothy.
If I could just jump in, Steve, and just say a comment, which is, and I think the point you've just made, David, is really important, because often, VCs come across as being quite elite in terms of you being able to have accessibility to them. But then once you're through the door, that's what's confusing and slightly contradictory. You can be so far down the line in your meetings with them, which of course takes time and resource on their part, just as much as it is ours, only for them to come up with really very unrealistic expectations, and the whole thing then falls through. So there's something about the system itself being inherently contradictory.
I think there's an element of is the system set up by the VCs, and the VCs are the ones that are actually and in some ways, I mean, just playing devil's advocate for a moment, is there an element of some VCs anyway, and Heather Ann or Jason as the kind of independents in the room, maybe one of you could answer this, is there an element with some of these VCs that they're being deliberately vague in order to kind of get themselves a view of as many opportunities as they possibly can, and that these additional requirements that are put in not in the initial phase of the conversation are almost there as a way of politely saying, no, we're not interested, just by adding additional hurdles. Heather Ann, do you want to answer that?
Yeah, I agree, absolutely. I think that some of it is laziness. It's easier not to put a bunch of information on the website and keep it up to date. I agree also, Steve, with the concept of you get down the track and suddenly they're looking for a polite way of saying, no, we're not interested. But from my perspective, it wastes everybody's time, and it just disincentivizes the investees to even go and approach them. You're told, go find people who know exactly what it is, do exactly what you want. I've been giving lists and said, oh, these are the people you should be touching base with. And you look at them and you think, we've got nothing in common. Have I found it on the website? No, I might have had to go to the Bohurst report or Crunchbase or something. You have to do a whole bunch of research to find it. Why not make it accessible? Put it on your LinkedIn profile, put it on your website, and be honest about what you're looking for. So you don't waste your time as an investor, and you don't waste the investees' time getting to meeting 3 or 4 and then realizing, oh, that isn't actually what we were expecting.
So that's a really, really interesting one. And we've already got a question from the audience, and I think it relates quite nicely to this. This one really aimed at Jason or Sarah. Phil Ashworth asks, do US VCs act in any different way to UK VCs in terms of these issues? And I guess as we've got a US VC in the room, Sarah, you're probably the right person to ask.
Yeah, short answer, I would say no. I think we're the same way. Our websites are pretty vague. Again, we don't put the criteria up front for us founders to really see who they should be looking after. It kind of works the same as what everyone said. And I think casting a wide net and seeing what sticks is part of the reason why they want to invest in the best founders and the best companies, and they're scared of missing out, quite honestly. So I think that's part of the reason why.
Really interesting. And really, you can always tell when you're going to have a good debate when your email goes mad within 5 minutes of starting the conversation. So, Sarah, I'm going to stick with you for this one. Errol Richardson is asking, on the point of finding investors who invest in companies like you, do you have any thoughts on approaching VCs who backed a competitor? On the one side, you'd like to be a good fit, but equally, is there an insurmountable conflict of interest? What's your view on that one, Sarah?
Yeah, I would say it's getting harder. In terms of saying no to competitors. We see competitors all the time at the firm that I'm at, but realistically down the road, if there's, for example, like a mental health company, you can't not invest in another mental health company because that's a big umbrella that we have in our portfolio. It just depends on the fund dynamics, I guess. And if you want to invest in this fund or another fund, and you also have to communicate with your LPs and your stakeholders ultimately.
David, you wanted to come in on this one as well.
Yeah, I think absolute direct competitor where there's two companies going for the exact same space, it's going to be really difficult, right? But within a broad umbrella like mental health, or within health tech, or within something that works with NHS, whatever it might be, then you should be okay. I think the important thing is for the VC to know and to discuss that potential conflict both with its portfolio company and with the company that's looking for funding. And if both are cool with it, then I think you can manage the conflicts. We had one very similarly. We've recently invested in a business that is a small version, slightly niche, of one of our large businesses in our portfolio, PKI. What I did was I rang the CEO of the bigger business, with permission from the business that was looking for funding, and asked him what he thought. Would it be a problem for him? Would it be a problem for the portfolio? As long as you have the open conversation, I think it's fine. And I think to try not to compete, not to get into space where we've got one company in this space, we can't possibly invest in another business in that space, naturally just shrinks your potential pool of potential investments. So I think it's something the VC should be able to do, but everybody in that transaction needs to know exactly what it is and be comfortable with the potential conflicts. The worst thing you can do is just decide it on your own and then surprise your portfolio company or surprise the potential portfolio company with the news that actually you've already got a business in that space, because that's when shit conversations happen.
Okay, Jason wants to come in on this, and then David, can I ask you to be really brief, guys, because we need to get on down the questions. Jason, to you.
Yeah, sure. I don't want to be the apologist for the venture capital industry, but I just think there's just a couple of dynamics to think about is especially in the healthcare space. I mean, the amount of startups, the amount of entrepreneurs who are coming up with interesting, new, innovative ideas, it's accelerated so much in the recent years, which is great. But at the same time, I think it can be a little overwhelming to try to stay on top of this amazingly dynamic industry and time. So I do think part of the frustration that is being felt is a lot of these VCs are just kind of overwhelmed with deal flow, which is great on one hand, but at the same time can be a challenge just in terms of being responsive and also I think some of these VCs are also trying to be entrepreneurial. They're trying to look for what are the best opportunities. So that's why I think they're a little vague. And the last thing I'd say is about this is that we also we're talking a lot about the dynamic between VCs and founders, but there's also the dynamic between VCs and LPs. And the VCs have to go out and raise funds themselves. And they need to constantly be looking to prove to the LPs in a market where the LPs have lots of investment opportunities. They have to constantly be figuring out how do they differentiate themselves in the market? How do they prove their value, especially when the VCs are out trying to raise institutional funds. And that's a highly competitive, challenging environment. So I think, and that absorbs a tremendous amount of VC time, especially among the smaller VCs. So that's, I don't know, as I say, I don't want to be the apologist for the industry, but I do think that's a couple of dynamics that are important to take into account.
I think it's also important to have some balance, Jason. So thank you for providing that. David, quick one to you.
Yeah, very quick one. Just to say, and it depends at the stage where the VC is at. So in early stage, less so, but when you're involved in later stage, actually having perhaps not direct competitors, but having complementary businesses in the same sector actually provides an opportunity for you a year, 2 years, 5 years down the line to do a consolidation play where you put the two of those together and then do a roll up. And then, depending on where you're at, you can sell that onto a private equity firm or list it or whatever.
And we'll come to the complementary point a bit later on, actually. I know Elliot, particularly his question was around that. But let's move on to the next of our statements. Mark Molnar, we haven't heard from you yet. Mark's point, and this is almost kind of one back for the VCs, I guess. The business needs to be innovative, not the individual. The individual needs to be a good and relevant fit for the business. So this, I guess, is thinking about the kind of relationship between the founder and the business. They're not necessarily the same thing. Mark, do you want to elaborate on that?
Yeah, so this is part of the Tier 1 Innovator Visa program that the UK government runs badly, unfortunately. So it's where an overseas investor invests in a UK company, early stage, pre-revenue business, innovative business. and they can be seen as a co-founder of that business because it's so early stage and because they're making an equity investment. So basically it's for people who want to come, maybe stay long term in the UK, maybe settle in the UK, want to bring their family. It's a really good way of getting early stage funding for smaller innovative businesses. The individual does not need to be innovative. They don't need to be a software engineer, a doctor, a pharmaceutical R&D specialist. The business needs to be innovative, and the individual needs to be a good fit for that business. So they could work in business development, production, marketing. They don't need to be, developing the product from its infancy through to MVP and then launch. So it's a scheme that the UK has run for a long time. The investor scheme has recently been canned. We are hoping that action will mean there will be more money coming through the innovator scheme, but it won't if the government doesn't do something about promoting it. There are about 40 endorsing bodies in the UK who manage the process prior to the Home Office rubber stamping it. About 500 applicants came through that scheme in 2019 to 2021. 430, I think, were successful. So it's a high success rate, but it's barely over 200 people a year. And given the investment's usually around about 100,000, that's 20 million, so 10 million per annum. It's 20 million per annum, sorry. It's not even scratching the surface. Yeah, it should be an absolutely fantastic scheme. And those overseas investors should be good experience, good qualifications, should be the sort of people that the UK should be looking to bring in.
Thanks, Mark. I think thanks for explaining about the scheme. I want to come back to this point about the founders themselves, though. And we've got 3 or 4 of them on this call, and I'm curious and interested. Elliot, we've not heard from you yet, and then I think I'll go to Romano and then Himanshu. From your perspectives, how much do you feel like you're selling yourself, and how much do you feel like you're selling your business?
So I think now I feel like we're selling the business a lot more than we're selling ourselves. Like at the beginning, it was much more around sort of the idea, the team that are going to do this. Are they committed? What's their vision? And that, I think, just as the business evolves, like it becomes much more around sort of much more measurable metrics, I guess. So revenue, growth, customers, churn, those sorts of things. So yeah, I feel like we're about to raise again. This is our we're just preparing for our next raise, and so the story now is very much less about what we think and much more about what the business is doing. I think that's just a natural evolution.
I think that probably kind of makes sense, and it certainly should be about the business, not necessarily about the individual. Mark, you wanted to come back on that?
Yeah, I think ultimately you have to sell the business. Being brutal, the team can be changed. If a team member's not a good fit, but the team is one part of the business. You've got the business, you've got the product, you've got the markets. You've got you've got everything, all the resources the company has. Then you've got the investment, etc. So a team can be changed, but to start changing direction for a business or a product or service, then that's a huge movement. So that's why I think eventually, once they have investors are happy with a team, then they'll say, right, now we can concentrate on the business, holistically.
Thanks for that one, Mark. Sarah, I think I saw you waving your hand there.
Yeah, just quickly here. I think it really depends on the stage. Again, like Elliot mentioned, I think early on you could pivot the business if you have a strong team behind it. If you have a team that could think innovatively and think future forward, then I think that strong team with that background could pivot the business. But later on, it's harder to pivot, obviously, once you get this funding. So later on, you could change the team, but I think it really is the dynamics of when you're seeking funding and what stage you're at.
Yeah, and certainly it does appear that in the early stages, the founder's vision, the founder's ideas are important. But as I've found in my own business, I think you have to evolve to the point at which you are no longer the business, and the business can sustain itself without the founder. David, did you want to come in quickly on this, and then we'll move on to Romano's next point?
Yeah, I actually just wanted to just slightly disagree with Mark, probably, and also sort of potentially with Elliot slightly. I think the business is kind of what gets you interested. If you're, especially in venture, you're interested in the where it's going, the metrics. As you've got metrics to measure, then obviously you're looking at those things. But ultimately, as a VC, you are looking to back the team. That is where most of the sort of decision making comes into it. So I think what happens as you get bigger and and you become moving through from pre-seed, seed, Series A, etc., although quite what those titles mean anymore, I'm not sure. But as you move through the gears, the business will get you, the metrics will get you kind of the meetings and get VCs interested in you. But fundamentally, every VC is looking at whether the management team can execute on the plan and deliver the vision. And also, and this might be just personal to Bridura, we're looking at whether we like the people we want to work with. We don't want to work with any dickheads. You want to work with people who you want to spend time with, and that should be both sides. So founders should very much be looking at the people in the VC team going, do I want to spend time with them? And so it ultimately comes down to it's all about people. And yes, the theory goes that you can change management teams. Yes, that is potentially in the back of people's mind. But as an early stage VC, if you are thinking about changing the team wholesale at the time of making an investment, the thing I would suggest is don't do it. Don't invest. Don't get involved, because that's not where you want to get to. It's a theory, and I think perhaps later down the line at private equity levels, you're profitable, you're growing, things like that, then maybe the management team are separable from the business. But for me, the business is what gets you through the door when you've got the metrics, and it's the relationship with the founders and the belief in the founders. They're the stars of the show in any startup. They're the people who are building the business. If you don't believe in them, don't invest. So I guess going back to what Elliot said, the business has now got metrics that people look at, but actually it'll still be coming down to people looking at Elliot and his co-founders in the eye and thinking, are they going to deliver on this vision? And if they don't believe it, going back to things that have been said previously on this call, that's when all those silly other excuses or additional hurdles get put in the way, because it's a nicer way of saying we just don't believe you're going to execute on it.
Elliot was nodding so hard at those points that you were making, David, that I thought his head was going to fall off. And it's interesting, actually. I can't resist at this point, actually, drawing on my own experience. And my last but one business, I sold out from my original investors to a new set of investors who within 6 months were trying to push me out of my own business. They did. It cost them a lot of money to do so. And within 3 months, that business had literally driven itself into a wall. So there you go. That's what happens when you remove the people with the vision from the business. Not that I've got any axe to grind on that one, but there you go. Moving swiftly on, let's get on to our next point. Romano, your question, at what stage does a company need an MVP? Do you want to just expand on that one a little bit and tell us what your thinking was there?
Yeah, so good morning, good afternoon, everybody. So we're setting up this new venture in a bit of a different way. In my opinion, a lot of entrepreneurs think left to right in the whole cycle, and we work now with a big, let's say, corporate team to help us go scale bigger, and they really think from right to left. So they came up with a KPI system. What you got to have an MVP out in 100 days, you got to be profitable in 150 days, you got to go to Series B in 300 days, and then you got to build an exit plan in, let's say, 4 or 5 years from now on, which really works for a part of the team because we're really KPI driven, and we actually got our MVP out in 96 days. But is that a way that a lot of VCs think? Is that a right way to do, or what stage do you guys think you're going to have indefinite time to get your MVP out as long as it's a good MVP? Is there a matrix for that?
Which of our investors would like to take that one on? John, we haven't heard from you yet. Have you got any thoughts on this one?
I don't think one size fits all. I really don't. If you depending on the nature of the business, and most of the work that I deal with is in healthcare, the changes that happen within that company within 15 to 18 months after the investment goes in, there aren't any, to me, set matrices that will actually establish a model that you can rely upon for that. I think you can certainly try when you first start and you're looking at a company coming to you for investment. But if you're lucky enough to get that investment on day one, I think the one thing you'll always guarantee is within 18 months to 2 years, it's completely changed. And after the 3 years to 5 years, you won't even recognize the business, possibly not even the management team. And by that time, you're looking for more funding, probably after year 3 anyway, because in the UK, you don't get VCs investing for longer than that period in terms of the money that's available to it. So you're always on the search, either to see the size of the drip or the size of the drip from the grants in the UK that can actually help it survive. So I would not say no, there's no real matrix that I would actually rely upon for the nature of the company. And I know this forum is about digital, but that's even more difficult because it's such a dynamic area. Everything is changing in that. And I think without reference to, if I call it the US market for money, which to me, for young companies is probably more mature, with the angel platforms and with some of the platforms that there are, I think you are in danger, particularly in this new market area. It was IoT, it's now digital, of not being able to compete. If you have that matrix and you try and stick to it, I could only see problems happening coming up in the sort of by the end of the second year and certainly thereafter. You cannot plan for this, mainly because the pace of change is so fast. And I was going to actually say just something very quickly beforehand, which was where you are lucky enough to get a business and you've got the founder, and he is very, very important at the beginning, as is the team, totally agree with that. But where is the venture capital groups or the funds actually contributing at the board level? I know we may come on to one of those questions, but you need to have also some maturity and grey hair around the table. The VCs or the funds have confidence that you are actually going to do the best you can for that delivery. And where they've been through the ups and downs of funds, I think that group is massively important in terms of board contribution, not just founder and team.
And you're right, John, we are going to come onto that in a moment. In fact, it's our next question around what else investors can offer rather than simply just money. But before we do that, David and then Jason wanted to come in on Romano's point.
Yeah, I know, Romano, it's an interesting approach. And I think, the reality is everyone has to have a plan. But as Mike Tyson famously said, everyone has a plan until they get punched in the face. And one of the realities about business is you get punched in the face. I've been doing some work with a tech company, and things were going great guns, but they'd outsourced all their tech to a team of 35 people in the Ukraine. And all of a sudden their tech team are now fighting in a war, and they're having to scramble and completely rework their plans. That was something that nobody saw coming. And to my mind, the real test of a management team is how do they deal with those kinds of things, as opposed to, hey, we've got a plan and in 90 days we're going to do this, and in 150 days we're going to do this, and in 3 years we're going to do this, because it's just made up.
Jason.
Yeah, I think that it's interesting to think about timeline and how VCs look at timeline for businesses. Is that sometimes it's a reflection of the VC itself, in terms of what's the VC, how are they performing? What are their LPs looking for? I mean, everybody wants quick wins, but sometimes if you've got a very successful, well-established, bigger VC, they can have a longer time horizon. I mean, I'm struck by the investors in a company here in the US called Galileo, which basically was trying to build a model of primary care for very complex, very vulnerable, low-income individuals that was without walls. So an entirely mixed model of virtual and home visiting and that type of model. Understanding it, and the investors basically backed this company with an expectation that it wasn't going to achieve profitability for 10 years. Which is a long time horizon in the world of VC. But I celebrate that in the sense that I think it's great. Sometimes really good ideas take time to come to the fore, and we need to give them the runway to be able to do that. But not every VC is in the same situation relative to being able to turn back to their investors and say, hey, we need time in order for some of these big ideas to come to fruition.
Thanks, Jason. Romano, I think you wanted to respond to some of these points.
Yeah, so obviously it's a very interesting conversation, I think. So from the one hand, the VCs in the room say, we want to give you time because you cannot drive a business all by KPIs. But then we as founders say, well, that's really great, but you want us in day one to come up with a 5-year plan. And if we don't stick to it, you come up in a board meeting and say, well, that's really great, but this is not what you promised us on day one. So I understand and I agree that you cannot run a business purely on KPIs, but I think the thing is, if you set a timeline on 100 days, at least it pushes the team and yourself to we made a right assumption that we can do it at 100 days. So I get both sides, but I think also the VCs really want from the founders to come up with a 5-year, 3-year, 2-year plan and ideally stick to it.
I think, Romano, at the end of the day, I think there's a couple of things there. I mean, I think any business, when it's forecasting, the further the event horizon is from where you are at that particular moment, the more famine, plague, pestilence, and war, not to mention the 1,000,001 other things that you can't predict, is going to change what that looks like. I also have a certain amount of sympathy for investors that want those kind of plans, because at least they want some idea of what's happening with their money. David Foreman, did you want to respond on this?
Yeah, I was just about to say to Romano, I can feel the frustration in there in terms of they say to give you time and then they hassle you at board meetings to do X, Y, Z, and why haven't you hit the plan? I think at that point you've probably got the wrong investors. Anyone, an investor and a VC who doesn't have empathy for the fact that the plan is an idea of what might happen, is not in the real world. I think one of the other problems with VC, and I'm big on the problems in VC at the moment, is people aren't founders. We've built our business to 130 people. We've taken us 11 years. I think we've probably for the first 9 years missed every budget we ever set. We raised less money than we thought. We've hired the wrong people, fired the wrong people. We've had to get rid of them and it's been expensive. Anybody who thinks that mistakes and plans don't happen or mistakes don't happen has no empathy for the fact that the founder is absolutely trying their best to do what they said they're going to do, is just the wrong investor. So if that's the frustration, it's probably because you've got the wrong investor, not because you're doing something wrong. You're clearly trying to build your business. You need help to do that. You need to be able to, have the time and support to do that. But to be beaten up in a board meeting is just absolute bullshit.
Absolutely. Thanks for that, David. Mona, you've been desperately trying. I can see you champing at the bit to try and get in on this one. Do you want to make your point really quickly, and then we're way behind on our questions because the debate's been too good.
One of the things that I find absolutely astounding in 2022 is that what VCs don't take into consideration is where startups are scaling internationally, there isn't enough consideration given to the cultural elements that we need to take into consideration. Case in point, we've just literally finished Eid, which means that because of the months of Ramadan and Eid in basically the Middle East, in certain aspects of Africa, it means it's down tools. So if you're being given, exactly as Romano said, these kind of really, what I think are slightly unrealistic deadlines, they're only unrealistic. Of course, I respect it from the VC end, but what's not taken into consideration is cultural diversity. And that is something that they really need to get on board with at this point.
It's ensuring that you understand all of the different elements of a business, which actually, again, I mean, I'm going to be the apologist for the VCs on this point. There I am wanting to spend money on something, and there are so many elements to a business that you have to understand. It's a really difficult thing to do. Let's move on. Sarah, to your point, you might notice that I'm trying to go investor point, then VC point, just trying to balance things out here so that we're not beating too hard on one side or the other. But Sarah's point, investors don't want to just be about money. There is more that they can do for a business that can help it to grow. Sarah, do you want to just explain your thinking there?
Yeah, definitely. So, of course, VCs are a lot about the money and providing that investment to help them grow. But I think a lot of investors really like to be value add. And I know that term gets tossed around a bunch of times, but at the end of the day, if an investor can build relationships, help them with operations, help them with hiring, financing, all these things that go unnoticed that may really help to grow a business. Some investors are all game for nothing is too small, doing comps analysis or finding an executive search firm for a hiring plan. Building relationships with their advisors or other people in their network, I think, goes a long way. And providing opportunities to introducing them to a potential customer may be more valuable than providing investment, for example, if you're not the right investor. So finding the dynamic there and trying to build relationships in any conversation that you have, I think is extremely important.
I think what I'd like to do here is I'd like to start with the example in the room, because of course, Himanshu, we haven't heard from you yet, and John is actually involved in your business, isn't he? So how's that kind of worked for you in terms of the additional value that John as an investor and also as a chair can offer to you?
Obviously, hello everyone. I'm Dr. Himanshu Kataria, the founder of CanCertain. And when I founded CanCertain in the management team, essentially it was us, really, me and my wife, up until the first proper investment which we received in 2020, and we had the ability to recruit the board of directors led by John. And the key difference really happens between having an experienced people on the board is around the founders' thinking process in terms of widening their vision and bringing practicalities within that vision. For example, for CanCertain, when I founded it, its vision was to utilize the 3D cell cultures to personalize cancer treatments to alleviate this failure rate of the cancer treatments. 45% of the patients don't get response to the treatment they are given. That was the main reason why, as a doctor, I wanted to set up this business. But then having an experience of John within the board, driving that strategy and overarching strategy, and looking at the individual parts of achieving that vision, makes the difference. And that wouldn't have happened if we wouldn't have had support of the Greater Manchester and Cheshire Life Sciences Fund to actually have the funding and also have the appointment of John as our chairman.
Thanks for that, Himanshu. John, do you want to give your perspective on that? What added value do you feel you've been able to offer?
Well, firstly, thank you, Himanshu. I wasn't sure whether I should have sent myself for a conflict of interest at that point, but I think having just experience of being up and down in companies, and as I said earlier, every company changes so rapidly in this business. The difference, I think, with CanCertain, and this is one of many, I would say, is where they span traditional areas of life sciences, biotechnology, but also trying to bridge now into the digital world. So suddenly everybody wants us to be digital. We don't necessarily want you to be what you were. And so you've got transitions that are available and necessary in a small company, which I think we all recognize the biggest problem for a small company is cash flow. It's also difficult where you have a company that has not got the huge long track record, but is building revenues during that time, to try and find funds. And that's the biggest issue. How do you go about it? We've been now at this fundraising for a few months now, but we're using actually an intermediary to help. Why? Because so many of the funds that we contact are suddenly not investing, or we spend time with them. It's trying to identify relevant investors, not just the investment community. And if anybody thinks you've got time to go onto websites, you don't. So actually intermediaries are really very important, I think, at a very early stage, because they will actually get to know who is actually investing, who might really be interested. And hopefully, as we have actually, they introduce other investors who say, well, we're not, but we know that David is, or Mona is, or whoever, and that is investing at that time. So I think you provide a stability of the group. So you're trying to help them be stable in front of investors. And then secondly, it's introductions. And it has to be introductions in terms of funding to be relevant to an SME, particularly a small one, where you don't have the luxury of changing horses after the first year or 18 months, but you need to be able to see how you can absorb it into a business model that will still be relevant to your old investors, hopefully, but also to new ones when you desperately need to get that second round happening. But I would say, if I just finish off with that, David Foreman's sort of very enlightened, if I could say, in comparison to a large number of the VCs that I speak to quite regularly. They actually respond premature to calls. So many VCs don't even do that in the UK, and that really is pretty unforgivable to firstly a founder, but secondly to intermediary brokers. They don't even reply. So it's a very difficult environment in which to work.
It's an experience I've heard tell of many times, is the investors that don't respond, which is appalling, really. I mean, at the end of the day, it's even an email that says thanks but no thanks. But let's hear from the enlightened David Foreman. David, you wanted to come back on this point.
Yeah, I could talk all day about more than money, adding value, all that sort of stuff. I think when you boil down VC, they've got three things to do. One, find and back exceptional founders. Two, help those founders build the best business they can. Three, build relationships with their LPs or investors. That's all we do. And I think a lot of VC overcomplicate stuff, but we've got our own method of helping founders build the best business, helping founders build the best business they can. And I could talk about that and why we've done it. And it's all around mentorship and operational partners and people who've been there, seen it and done it. But it doesn't matter how each VC does it. It matters that they've got a strategy for adding value. It's a strategy for helping founders build the best business they can. And importantly, the resource to be able to do it. If you are a 4-man VC, 4-women VC, whatever it is, and you have 50 companies in your portfolio, there is nothing you can do other than maybe turn up on a board meeting once a month and eat the sandwiches and ask why you're not on plan, because you haven't got any resource to be able to do it. We've made sure we have 9 operational partners with 27 companies in our portfolio. Every time we add 3 more companies, we add another operational partner. They are people who've been there, seen it and done it, and can add value and mentor founders and work with founders. And that's the entire operational partner networking with the entire 27 companies. Some are more focused on one, where it's the real mentor-mentee relationship. Some is situational advice. I could talk about that all day and I'd love to, but now's not the time. But the important thing when a founder is looking at a VC and they say, oh, we're here to add value, the big question is, how are you going to add value? What are you going to do? And who is going to deliver that added value? And if they can't answer those questions and they don't have people to be able to do it, then frankly, they're talking nonsense and saying, I'm just going to add value because they hope that that's the reason why you might pick them to invest in your business. So unless they have a plan to do it, it's the same as a VC asking companies want to do this. They want to have customer success. They want to build businesses. They want to, do whatever it is they're doing. And a VC will always ask, well, how are you going to do it? What are you going to do? And who's going to do it? But nobody asks the VCs, well, okay, how are you going to add value? What are you going to do? And who is going to deliver that? And if the answer is, well, it's just the finance person who's doing the investor, they're not going to have time, because most of the time they're spending time investing or managing LPs. So if you think there's 3 things that a VC needs to do, you need to have resource to be able to do each of those 3 things well. Finding companies, adding value, building relationship with LPs.
I think we should pause for a second so that everybody in our audience can write that down, because I think that's probably the best point that I've heard this morning. We won't pause though, because we're already short of time. And Mark, I know you wanted to come in on this point.
Yeah, I would agree absolutely with what David's just said, but the whole reason that we are here is because early stage businesses in the healthcare world and in other sectors are finding it very difficult to raise money. And of course, the first thing you do as soon as that checkbook is dangled in front of you is that all logic and thought goes out the window. So it's too easy for an early stage founder to say, actually, that is all I need. I just need money. But as David's just said, actually, what you really need is money and a partnership.
Absolutely, Mark. Absolutely.
It's too easy to jump, to jump in feet first just because somebody's brought money. And you need to think, but you need to keep your head.
Thanks, Mark. I think that's a really, really important point. Well made. Let's move on. Heather Ann Hubble. So your statement. Why are pre-seed and seed stage investors surprised to hear that the investor is pre or minimal revenue? Heather Ann, explain to us what your thinking is.
Yeah, I think this is a variation on the comment that Mona made earlier, where you and I think David commented on, is that you get partway down the road with what is supposed to be a pre-seed or seed investor, and then they sit in there and say, but well, where is the revenue stream? And you think, look, I've told you this is what I'm looking to do. This is these are the milestones I want to hit. I want to bring in the team. I want to do this. And so you sit there and think, well, how is it that you tell me that you're a pre-seed seed and that you're looking at saying, well, we need minimum amount of revenue before we can invest? And that kind of goes to a couple of points that other people have made. You look at the metrics. So if you're in that early stage and you're validating the concept, you're validating the product market fit, you're getting those, you're bringing people on to use your product for free, to trial it, you're creating all of those metrics that everybody tells you, those are all the growth KPIs to show that there's a business, it's worth it, but you don't have revenue because you've been deliberately putting clients on for free or working with them to deal with it. So now suddenly you're supposed to turn the switch and get them on and then be able to deliver. And I think it's a combination of what, maybe I don't want to say yes now because it's I've decided now I don't want to work with these folks, but really let's get clear right up front and say, if you want us as pre-stage investees to be working on those growth metrics, then don't expect us to be building the revenue. If you want us to be building the revenue, then those growth metrics are the wrong growth metrics to be asking us for. So you can't have your cake and eat it too.
Excellent point. David, do you want to come back on this one?
Yeah, the reason people are surprised and the reason people are asking you where's your revenue is because they want to have their cake and eat it. They want the pre-seed and seed valuation and the Series A and Series B revenue. It's very simple. That would be an awesome thing if you could get lots of businesses at seed valuation or pre-seed valuation that already had $1 million in revenue and ARR and then that's great, right? So it's either they want to have their cake and eat it and they want to have because that's what they would like to have, or it is a different way of saying, look, this really isn't for us, but we don't want to have that awkward conversation. So we're going to add as we've talked about before, another hurdle in to see just as an easy way of you guys self-selecting out, because no one likes to have it's just not for us conversation because that's difficult. But the honest answer is they're either not seed and pre-seed investors, or they actually just want the valuation of a pre-seed, but don't want you to be that.
Himanshu, you like to come in on this one?
Yeah, I think it's also a combination of things, particularly with the healthcare industry, because quite a number of healthcare companies and the products are very high margin products. So if the company has actually done £1 million of revenue, which is their sort of baseline to invest in, company might not actually require the VC funding because their margins are so high that they are cash generative and they would not look to actually take on additional investment. The second point is around, this might be just culturally within Britain, that we don't really tell negative things on the face. Whether it is like they just didn't like me, they don't want to tell me that they didn't like me. They just want to put another argument for the sake of it to say no.
That's kind of the point that I was making earlier on. It's and I do wonder, perhaps Jason or Sarah could speak to this, whether there is just this peculiarly British thing about, well, we're far too polite to say no, so we'll come up with an excuse anyway. Sarah, Jason, if you want to come back on that one in a minute, let me know. In the meanwhile, Elliot, you wanted to make a point.
It's just on the point about sort of being early stage or pre-revenue. I think that companies can do even if you're not generating a huge amount of revenue, you can probably show how much you've learned about how to generate revenue. And that's something that we've found has been really helpful in speaking to investors, is getting into the detail of, well, historically we were targeting these people, we've learned that we should be targeting these people, and we need to do this piece of work up front. So your whole customer onboarding process could do with some scrutiny from your investors so they really understand where the revenue is coming from. I think that's helpful.
Yeah, it's about, I mean, I suppose all of this is about de-risking, isn't it?
Yeah.
So, you know, if you're talking about a pre-revenue business, then it's about turning around and saying, well, actually, how do you, as much as possible, de-risk the idea that eventually there's going to be some money in this somewhere. Jason, you wanted to come in.
Yeah, I'd say that the one dynamic of this conversation is the I think it was raised earlier about the power dynamic, being that the VCs have the power and the founders don't. It's interesting is that in the last few years in the US, that power dynamic hasn't been quite that clear cut. And Sarah knows this full well, is that I've been involved in many a deal where it's really the founder who's got a really good idea, very interesting company, who has more than their fair share of choices when it comes to VCs, basically batting down their door, looking to invest because they see the promise in the company. So, and they, it goes beyond just the money question. It really does come down to that value proposition that, how can you help me introduce me to potentially new customers? How can you help, are you going to be a good investor in terms of being active on my board? I think those are the kinds of things that the dynamic, I think, we go through ebbs and flows and the economy and other things, but at least in the last few years, it's been definitely a dynamic where founders, at least particularly in the work that we do in the US, a lot of founders, particularly experienced founders, have had more of the power in their hands than the VCs.
Thanks, Jason. Mona, quickly, because we need to move on. And it does help if you take yourself off mute.
Just a comment for me, really, which is one thing that always impresses me when I meet a new VC is when they get the question in very quickly of, what are you looking for in an investor? What do you need from your perspective? I like that. I think that immediately tells me something about the VC. I think it addresses the issue that Jason's just been talking about that power dynamic. And I have to say that even though all startups go through the cash-strapped, obviously, periods and the bootstrapping, et cetera, I think it's really, really important that we maintain our integrity and are really clear that if we get in bed with a VC that is not right, it's not a cultural fit with our companies, it is likely to cause more damage for us further down the line than if we actually are a little bit more selective, a little bit more grounded about the way we approach this, and then subsequently find our appropriate suitor.
Thanks for that, Mona. John, you want to come in?
Yeah, just very quickly on the point. We're all assuming that if I say founders and very small companies have choice. And actually, I would say choice equals desperation for so many young companies when they're trying to get their initial funding. If you have to sit there on your own, maybe you don't have a board, maybe you don't have much support, and you are across from a VC and you say to them, well, what is your value proposition? You're going to come back to me and we're actually going to go somewhere else. We don't like you enough. It's fear, because the fear is you're not going to get that. And the VC community is a small one. People talk. If a company gets a reputation or a person gets a reputation, it's a very small world. And the fear is you're not going to get your money. I wish we were all in the luxury of being able to say, there's 6 investors, John's one, David's another, and I'm going to choose my panel. You must be very, very rare if you're in that position for it. And the second point I'd say is, in the US, there is this cycle of founders, success, reinvestment, new founders. But the difference is also in the percentage of the shares that they're still allowed to have in the companies that are successful. In the UK, it's around about half the percentage that is retained by founders than it is in the US, because they recognize that value of the founder, that value of that team to be able to do it once for them and maybe 3 or 4 more times. And I don't think that is really recognized in the UK in terms of either options and or founder shares in ways that we're going to then rebuild those entrepreneurs to do more and more companies. And one failure doesn't mean you're not good. One failure means you've got the business to tick up on your side. That gives you the experience to go on and do it better and hopefully successfully the next time. I don't think we've got that culture in the UK.
I think there's an absolutely brilliant couple of points there, John. I mean, the point about desperation is a really well made one. I think as having been there, done that, when you're in that situation where, you're running out of cash runway, you're pretty sure your business is a good one, and you're desperately needing money, just as a pure human need to be able to pay your mortgage, ensure your staff can continue to pay their mortgages. Your staff at the end of the day are people who are putting their faith in you. And if you are in that situation where you need that investor cash in order to be able to just keep the lights on, then actually there's no such thing as choice. You kind of got to take the money wherever you can find it. It would be nice to think that we were able to pick and choose the right investors, and certainly if you can, you absolutely should. And if there's any way of kind of hanging on to make sure you're not getting, having in my own personal experience, having got into bed with the wrong investor on at least one occasion, that can be as fatal as running out of money in the first place. But there you go. Let's move on to Elliot's statement. Elliot, to what extent are investors building cohesion and collaboration opportunities within their portfolio? Talk us through your question.
Okay, so our general viewpoint is, and this this can't be true for Infinity only, is that small companies are trying to solve some pretty big problems. The NHS, just in the UK alone, the NHS is an enormous organisation to interface with when you're sort of 10 or 20 people or less. But we have these huge ambitions that we're going to solve these enormous problems. And my general view is that we're just much better working collaboratively in partnership with other SMEs. So there are lots of companies that are trying to solve other problems, big problems in healthcare. And where we have an advantage is that we are at similar stages, we probably build on similar types of platforms, and together we can be much more agile versus the incumbents that we're trying to unseat. So to Sarah's point about sort of your VC or your investor can bring a lot more. They can bring network, they can bring knowledge and understanding. I'm wondering, like, we've seen real benefit in partnering with companies like the best digital health companies in the UK, and that's where we're now seeing the most growth. I would imagine that a fund that's trying to nurture some collaboration within its portfolio would yield benefits. Is that being done actively? And is it being encouraged? So if those companies see an opportunity, but it's also going to require some additional capital, would the VC consider funding that or carving out some of their fund for those sorts of opportunities?
So this is a really, really interesting point, Elliot, and it actually gives me an idea, because at the end of the day, as Healthcare World, we spend our time taking, innovative digital health companies all around the world, introducing them to governments, to providers, to opportunities in different countries around the world. I guess I almost feel like wanting to challenge our investors in the room and say, right, all stick some money into this and we'll invest in a whole group of digital health companies through Healthcare World and do it that way. There you go. What do you think of that idea? Vaguely serious question. Well, it's a vaguely serious idea, actually. We can maybe talk about that one later. But does anybody do this at the moment? Amongst our investors here in the room today, are any of you actively looking at your portfolio from the way in which you can kind of share opportunities and share customers amongst the groups of organisations that you're working with? Who wants to come back on that point? I'm going to pick on David Horn because we haven't heard from him for a while. David, what do you make of this idea?
I mean, it makes logical sense where there's, a good reason for it. I wouldn't want to try and shoehorn things in to say, oh, well, we're only going to invest in companies if we can do cross-selling between portfolio members of the thing. But if I've got company A and company B and one is a supplier to the other, or as a supplier in the industry, but perhaps doesn't have them as a customer, then absolutely I'm going to encourage them to, introduce the two founders. Let's have a chat with each other and see if we can keep the money cycling through our pool of investee companies. So it's something that we would always be on the lookout for, but I wouldn't say that it's a core element of our strategy. So if we saw a company and we didn't know how it was going to fit with other opportunities, but it was still a good company, we wouldn't say no because of that. So it's kind of it's the cherry on the cake.
Jason, you wanted to come back on that one?
Yeah, actually, in the U.S., there are VC funds that are built exactly for this purpose. So let's say, for instance, large hospital systems create VCs, and they explicitly invest only in companies that ultimately could be a supplier, something that they're going to basically create, say, technology or a service that ultimately the hospital system will buy. And so they're definitely entities. And I think that's also to think about is if you are looking to raise funds, there's lots of different types of VCs out there, not just sort of the general sort of healthcare venture funds, but ones who are sort of purpose-built and have very close connections to potential customers, especially let's say if whatever it is that you're developing, you want to sell that to hospitals. There are VCs that basically only invest in those types of solutions. So I think there are models of that around the country.
I've seen it, and I've seen a couple of examples of this in the UK, where VCs are going around, very often trying to buy up rather than just specifically invest in groups of digital health companies as a way of kind of amalgamating products and selling them jointly. I think the issue sometimes is the fact that the ones that are for sale are not necessarily the ones that fit together properly in terms of providing a kind of a whole health system solution. Certainly that's something that we've been thinking about quite a lot in terms of how you would bring together a consortium of digital health companies that fit together and provide a kind of whole customer, whole patient journey. David, do you want us to come back on this point?
Yeah, I think to sort of some of the points that were made, you know, there are particularly sort of corporate VCs in particular are quite good at sort of buying into our space and providing those sort of network effects for businesses all servicing the same region. The problem with corporate VCs is often they are effectively buying a stake with a view to eventually buying the company, and that might not be the best outcome for the founders. I think in terms of sort of more generalist VCs, it's quite challenging until you get to significant scale, because we talked before about competitors and how comfortable are people being in the same portfolio as people who are either competitors or quite similar businesses. However, that's not to say that VCs can't generate collaboration opportunities between portfolio companies. So, for example, you know, we have a number of health businesses all selling into the NHS that they are all introduced to each other as founders, and they all spend time together talking about the best way of going about things. You know, that's something we have we have a general founders WhatsApp, we have founders WhatsApps for marketing, founders WhatsApp for recruiting. So we try and pull together all 27 founders together to get the power of scale. Similarly, we do deals on behalf of our portfolio where with providers who all might provide support to our founders. So we use the power of scale to get discounts off things that people use within the portfolio, within any founder business. So we can often pay for, you know, we've just taken on a business in January, and we've already saved over 300 grand of costs that our business would have spent in the next 2-3 years since we invested in January. Now, obviously that's not the reason to invest, but it's helpful, especially when, you know, any cash that's not being spent or additional non-dilutive cash is great. I think VCs can do a lot more of that, about creating savings. And also we built a portfolio reporting system for our portfolio. We built it with PKI, who are one of our portfolio companies, and we pay them. And we also use some of our other portfolio companies' services within our business, because A, you should be able to eat your own dog food, and B, I just think it's a great thing to sort of engender that whole, you know, community spirit within the founders you've backed. So if there are products that are generalist products that are useful for all businesses, we would absolutely encourage other people in the portfolio to use them, as long as they found benefit in it. So I think you can do it. I think you can do it a lot more once you get to a scale of founders in your portfolio. You can start to drive benefits. Whether you can definitively say, you know, company A should work with company B and do a targeted, you know, pitch or tender to the NHS, for example, I think to look for that is quite challenging. But if it's there and staring in the face, obviously you should try and help that happen. Similarly, you know, we've just met Elliot on this call. You know, Patchwork Health is a business we're invested in, and that's a conversation that should definitely, Elliot should definitely meet Anas and Jing and know them and things like that, because the more we can do to help both our business and Elliot's business, that's a win-win all round.
See, Elliot, I told you it was worth coming on this call. I think there's a really interesting point that David makes, actually, which is that whether there are mutual business opportunities for a startup or not is one thing. But one thing that a VC with a portfolio of companies should definitely be able to provide, particularly to a bunch of early stage companies, is that kind of shared back office support. You know, if you're dealing with a bunch of really early stage startups, giving them access to kind of joint facilities for things like credit control, invoicing, all of those kind of sticky bits and pieces, which we as magical dreamer entrepreneurs are really usually not all that good at, is incredibly useful. Mona, you wanted to come in.
Yeah, just a small point, really, just on the back of what David said, which is, you know, I think we're all relatively aware of those of us who work in healthcare about what the pain points are, the existing pain points are in the integrated care systems across the NHS. And I think absolutely in terms of collaborations where you've got, you know, we've all got our individual solutions. I'd like to think they're all innovative and disruptive, you know, where there's clear synergies going on. For me, it is a no-brainer to be able to present, to co-present in an NHS environment where we are directly going to the heart of their pain points. And I think sometimes what we do is we think as founders, I'm turning it back on us now, where we think, you know, we're so involved and so passionate about what we're doing and saying, you know, we've produced this incredible product. Of course, everyone's going to want it. Well, that's a very small piece of the puzzle. We've got to be tactical and strategic about the existing pain points in our healthcare system.
Is there not also a really interesting point here? And I think, Mona, you're the ideal person to ask this question of, because you were out at Arab Health with us, with Healthcare World and a whole bunch of UK digital health companies back in January, where as much as we were talking to people on the Middle Eastern side, so potential customers, we also ended up talking, you know, creating some incredible partnerships and incredible kind of linkages within the group, where we ended up kind of jointly running after opportunities, some of the Saudi things that we're involved in at the moment. You know, I guess the question that I'm interested in, back to our VCs, to our investors, is actually, you know, when you see a couple of digital health companies or a couple of organizations running together at a thing and creating a joint venture, is that something which you guys would be interested in looking at? Is that something that you would find investable? Sarah, let me ask that question of you, because we haven't heard from you for a while.
Yeah, that's an interesting question. I haven't really seen it in the past. I think it would have, yeah, I mean, if two companies are coming to you to look to like consolidate, then it's interesting to take a look at. I don't know how like behind the scenes, like financials and all of that would work. So it's something obviously to look into. But one point that I do want to make, at least in the US market that we're seeing, is consolidation throughout all different verticals like med device, but also throughout digital health and biotech as well. So I think we're going to probably see more of that going forward.
Thanks, Sarah. Let's move on then. John, this is to your point. So you're talking about should funding from either of investors or UK grants be milestone-led in the first 2 years? And for grants particularly require match funding percentages from the grant bodies, particularly where other countries offer 100% upfront payments. Do you want to explain that one to us?
Yeah. The early stage or SME companies need to know the size of the pot that they can invest. And there has been a tendency for a number of VCs in what I call smaller sums of money to do it in stage payments. And the trouble with that is you can never build the plans, the projects, which often will never go into the timeline that you hope for. You only need a war, you only need COVID, whatever it might be. In that time, you need to know that that money is actually going to be expended and that you have access to it. It's up to the VC at that point to ensure that the governance is in place to show that it's going to be paid properly. Absolutely. Reports, absolutely. But you need to know you've got all of the money. And I would say similarly with grants. So many of the companies that I've come across have 70-30% splits from the UK government on grants. Problem with that is actually finding enough money to get for the 30%, because often when you win it in years 1, 2, or 3, you don't have the funds to be able to spend to actually have that contributed. Go to the States, go to BARDA, go to the various of the grant bodies throughout the United States. It's very rare to get it staged. They use funding, grant funding from the governments and from their individual states to actually provide those US companies with the leading base for funding for going forward. So it's used as a competitive advantage by the US. And I understand that. We should be doing the same. 70-30 really doesn't help because you've got to find the 30% and then you've got to go fundraising again. I would like to see the UK come back to 100%. If you're going to invest in the project, invest in the project, provide the company with the governance that is going to ensure that it's done properly, and that's fine. Europe doesn't do 70-30 when you used to go and get European frameworks or horizons. Why should we? And we're trying to be competitive with building companies to compete with the US ones. I just think it's wrong. You should have that immediately. And I think funds should also commit those funds immediately. There should be no milestones in years 1, 2, or 3, because you've got to have the stability to build a company against very unknown certainties. That's my statement.
Jason, have you experienced this from the US end? What do you know of this from in terms of the comments?
I raised quite a lot of money from the defense areas in the US for what I call UK biotechnology and biothreat areas. And you've got to have a US base, but I would always say to any company that has leading technology that they want to compete, you're going to have to compete with the US. Don't ever think you're so unique, you're the only one. And the UK is a very small market. You should have a US subsidiary as soon as you can, and someone over there that can help you to ensure you are unique and you can access US grants, because they will make that difference for you. So I'm a very big proponent of that. And actually, the other big leading area for the digital world, and you've said it yourself, Steve, is the Gulf. Dubai, Abu Dhabi, Qatar, they're all wanting to be the digital center for technologies and for companies. We need to get that, if I call, avenue going from the US into the UK, but also into the southern areas as well. But my experience is you get 100% of the grants in the US. They don't do it at 70% or 60%. So if you're going to go for it, go for 100% and ensure that the company that you're giving it to has a chance of actually delivering.
Jason, do you want to comment on that from a US perspective?
Yeah, what I would say is I think it's true in the sense that one of the challenges I think companies outside the US have is that, well, especially if they're trying to raise funds in the US, is TAM. How big is your total addressable market? And if your total addressable market does not include the biggest healthcare market in the world, which is the United States, that is a major limiter. And if you think about venture capital or any early stage angels or early stage investors, they're going to place a lot of bets, but they want some number of those bets to win big. And but if the TAM is limited, that just deters them. You know, they know things are high risk. They know that only 20% or less of their bets are going to actually come home. But the ones that do come home, they want those to be, you know, to have really big success so that they can balance out the bets that weren't successful. So that's what I think is that, you know, a lot of these companies, if you really want to raise, if you need to raise venture capital, I think you need to look to the other markets outside of the UK and include that in your TAM. But you know, my question for this group too is that what I see in a lot of the work we do is working with companies, particularly European-based companies, who are looking to enter the US market, and they've got some really creative, innovative solutions, but they don't really understand the US market. And in fact, they make some assumptions about how the market works that are just not true. And when they go in and begin to pitch US investors, they run into a brick wall because it becomes immediately clear during their pitch that they don't understand the US market. It's a big part of their TAM. And I think that's one of the big challenges are that, and I'm not saying company has to have the US market be part of its TAM, but if it is, that does open the door to more investment opportunities and potential growth down the line. But that means you also need to understand the market. And too oftentimes we see companies who just simply don't.
I think there's a general point there, isn't there, that if you are seeking investment to enter a particular market, then you probably need to be thinking about an investor who is in, or at least understands and has had previous success in that market. I want to stick with John's point. We'll come back to this, Jason. I know that the US market question is one that you particularly want to talk about, but let's just talk a little bit more first about what John was talking about in terms of this kind of match funding situation. Mark, I know you wanted to come in response to John's point.
Yeah, I agree very much with John. The UK grant structure is not as good as it could be. Yeah, it'd be great to get 100%. It would be great to get the money up front. And, you know, somebody somewhere, not me, needs to work on that. But there's a bigger issue than just 30%. There's then the cash flow. So we work with lenders who will accept the security level of somebody like, say, Innovate UK as security against lending against a grant payment, but it's all in arrears, you know, so you go through a quarter of expenditure. Well, you've got to have that money. That's in the 30%. Okay, that's fine. But if you're spending more than that initially, you know, if it's a front-ended project, then you're going to need more money. So, you know, there's so many different things, so many different elements to this. But the one thing I would say is, from an investment point of view, generally, when I've spoken to people, they like the fact that companies are applying for grants, particularly if they win them, if they're successful, shows a significant level of competence, whether they've used a grant writer or not. But it is a very difficult area. And the cash, you know, the cash flow is usually the biggest thing that holds people back. If they don't have the 30% or more, there's no point in applying for the grant. They're never going to get through the project.
Forgive my naivety on this, as I said at the beginning of the conversation. I'm by no means an expert in any of these matters, but to you, Mark, or to John, that 70-30 funding point, is that something which is designed to encourage investors to put some of their money into it? Was that the purpose of it? And is that something that makes a difference to investors? If you can turn around and say, well, I've got grant funding for some, can I get the rest of the investment out of you? How does that work? How does that dynamic work? John, you want to answer that one?
Just as a starting point to it, very rarely you're going to go into a grant unless it's going to be useful for your business, because it's just a divergent area of your activity. You've got enough problems, you've got enough activities to undertake to fulfill the goals that you have to deliver for your VCs. This is added non-dilutive capital to the company. So it's massively important. It's additional and should be additional cash flow. It should be, I totally agree with Mark, it should be upfront, because otherwise you can't afford it. But the other point is, you've already, when you get money in a company, you've already dedicated that to specific business activities. And this may well support it, but you're never going to be able to fund that separately of that 30% when it's a windfall grant. You don't know whether you're going to get it, because the UK is still very driven by competitions, and you only get a certain percentage of those that win. If you do, that's great to have it, and you do have to show that you've got the capital, but you've got to go and find that capital, where most of it is dedicated in SMEs to the traditional activities. So that you will often have to say, well, sorry, I can't actually match it, and I can't actually do it, but you have to make a statement to that effect. It is meant to be so that you are going to make sure that it works. So there's a little bit of mistrust there. Some may be naturally correct, but in the main, companies only take on grants because it's valuable for them to do so, and it's a means of building the company and its business, and hopefully taxation and all the economic benefits that come from it. But if you can't afford the 30% out of your cash flow, you're not going to be able to go and get it anywhere else, unless your venture capital fund or whoever it is actually willing to support it by putting more money in. So where are you going to find that 30%? It's already dedicated, quite rightly, to the deliverables and goals that your venture capital, your fund, your funders are actually requiring you to do. This is meant to benefit it. It's money that's free money. If it's a grant, certainly it's free money. You're not having to dilute the capital of the investors and or the management team, employees, whatever, to do it. So to me, it just doesn't work as a whole concept of saying it's 30-70. You've got to give it so that you have the cash flow to be able to make this happen. The cash flow has to come on day one. It can't be beyond that. You also can't make it, you can have it in year one and then you can only have it for year two. You're making commitments to staff, to everybody, for the deliverables, which are often 2 and 3 year grants. And they're with entities that need that confidence for them to become part of that consortium. That was one of the big problems at Brexit. Nobody knew whether we'd be able to even still continue to contribute to it. We need that confidence to go into these grants, and that needs to be for the companies to have the cash flow.
Moni, you want to come back on this point really quickly? We've only got about 6 minutes left, so I need you to make this really brief. It doesn't. You're having problems with your mute button again.
Oh, not again. I just fully agree with what John's just said, and we have in Nexus we've actively avoided the grant route to date for that very reason. But actually, I just wanted to very briefly come back to Jason's point about TAMS, because of course I think it was really a very, very important point. Jason, it's a question specifically for you. Do you think the Asian market would agree with you about your points that you just said about the US?
You mean in terms of needing the US market in order to have a large
Yeah.
TAM? I mean,
Yeah.
I think, you know, that there's clearly other markets that are large. I mean, China being an obvious one, but I think there's also a little bit fraught with concerns on regulatory issues at the moment. So, but I just think, I mean, just healthcare spending overall, for better or worse, probably mostly for worse, is just so much larger in the United States. And that creates, and I do think the other, in addition to just raw size of the market, is the diversity of customers in the market. There are lots and lots of decision makers, potential buyers of whatever service or product you're producing. So it de-risks it a bit in the sense that you know, you can put together a fairly large TAM, but you don't have to sell the single or one of a small number of customers in order to be successful. You know, just like if you're selling to payers, to insurance companies, there are lots and lots of those around in different sizes and different markets. If there's hospitals, there are lots of independent hospital decision makers that are out there in the space. So I think that piece of it as well. But no, I think there's definitely other markets, but I think whichever market you want to enter, you need to understand it in order to be able to convince someone, especially somebody who's an investor in that market, that you actually are going to be able to be successful. Because if you can't, and your point earlier, if you don't understand the Middle East and the cultural uniqueness of that region, you're probably not going to be successful there. Absolutely.
Thank you.
I think this is speaking actually to the point that we're kind of doing your question now, aren't we, Jason? Really, because this was the point that you wanted to raise, and my thought on this, from experience of talking to people across the US, and I'm interested also in Sarah's view here, how important is it for a UK, European, or any global digital health company to have a US investor if they're looking to enter the US market? Sarah, Jason, do either of you want to take that on?
Yeah, I would say is that it's probably less important if in terms of selling your service in the US market. How important is it to have a US VC backing you? Is that the question, Steve? Just to be clear. Yeah, I think that's less important. I mean, I think having a US investor can be exceptionally helpful in entering the US market. Because as I say, there's lots of different types of investors out there. And oftentimes, hopefully the one you that's backing you brings with them access to potential customers, right? They're going to have advisors on their board, or they're going to have portfolio companies, or like the example I mentioned earlier, where if you're selling a product to a hospital in the US or service to the hospital, then looking at the VCs that explicitly are backed by individual hospital systems or by groups of them, because then you get that money, then they have a direct interest in helping you sell your product or sell your service. And I think what is different here is, and we talk about digital health, and why I think this point is important, is that back when we were talking just pure life science, and we're talking about new drugs, new devices, and the use of those is somewhat, standard across all these different healthcare systems. We're selling digital health solutions. Context and health system design and structure become really, really important. And oftentimes what needs to happen is that you need to tailor that digital health solution to the unique nature of the market in which you're trying to sell it. It may work great in one context, and this both sides, of the Atlantic and all around the world. It's, you could have a service that works great in the US context, but would not work well in the UK context. But if you want to sell across these borders, across these different health systems, you have to be able to, describe how your system is flexible enough, or it can be modified to take into those different structural issues. And I've just seen quite a few companies who initially are pitching saying, hey, we have this great thing, we've done this great solution in other countries, but they haven't really done that translation. And I think that's a key point to think about.
And I think we've only got 1 minute left, and I want to get to Himanshu's question. We will come back to this in a future session, because I know, Jason, you and I have been talking about putting on a session on US market entry, and I hope, Sarah, you'll be able to take part in that as well. But let's get to the last question, because we've only got 1 minute left. Himanshu wanted to ask a question about EIS and VCT schemes. So why early stage pre-revenue or smaller revenue organisations struggle to attract funds from EIS and VCT fund managers, when the whole ethos behind the scheme has been to provide capital to early stage businesses? Himanshu, do you want to just quickly explain where you're coming from with that question? Having problems finding it, but there we are. Himanshu.
The EIS, the Enterprise Investment Scheme, and the Venture Capital Trust schemes are tax-efficient schemes to promote the investment in the earlier stage businesses who are unable to attract other forms of funding. That's what the government ethos is behind it. CanCertain is EIS eligible, and what we have found is that going to the EIS funds, often we get an answer that come back to us once you have further validation and further revenue, and we have a threshold of £1 million revenue for investing into EIS schemes. We have been more successful with actually individual EIS investors, particularly clinician investors who are looking at having tax efficiency. But the question here is it the EIS fund managers more concerned about capital preservation in terms of generating returns to their investors, which often would be individual investors, or are just afraid of taking the risk, which the ethos of the government scheme has been?
David and David both want to come back on this one. We are running a little bit over time, so I hope we're not cutting into people's lunches, all down to the appalling quality of the chair, I'm afraid. David Horn, do you want to come in on this one first?
Yeah, so I totally understand your challenge, Himanshu. I think the reality is a lot of the EIS funds raised their money by going out to investors and saying, we're going to invest in companies that have these criteria. And their criteria aren't necessarily purely the government's EIS criteria. So totally understand where the government was coming for and in terms of supporting that. But a number of the EIS funds that I'm aware of, they are focused, and they basically raised their funding from investors and said, we're only going to invest in companies that have these criteria. And if you don't have those criteria, you're not going to be a match for them. It's a shame, because it's not what the program was for. But as you say, you've been able to find individual EIS investors who are willing to take those risks. And unfortunately, that's the nature of the game. Those funds, particularly the bigger funds, the VCTs and things, they're going to have quite strict criteria where individual EIS investors might not.
David, Foreman, to you.
I think, to Himanshu, I think you should divorce the idea of what the scheme and the tax break is for, and what each individual fund is trying to do. Because just because an EIS fund is using EIS to raise capital doesn't mean that it's going to be all focused on extremely early pre-revenue pre-revenue businesses. I also think that, you know, historically VCT and EIS funds were doing a lot of solar preservation, capital preservation schemes. So they were largely funds set up to monetize the tax relief that was available. And you've got to divorce again between VCs who happen to raise money from using EIS and tax providers who then have to do something with the capital. If you're in the latter version of a tax provider who has to do something with the capital, you're probably looking for the safer bets. You're probably looking for the more, you know, for those things. Equally, we're an EIS fund, right? We do some pre-revenue, but not many pre-revenue businesses. But that's not, we don't have to do that because we raise money via EIS. We're a VC that invests in early stage businesses, but not necessarily pre-seed investments. So we're looking to invest $1 million to $3 million in our first investment. So just because we raise EIS doesn't mean we have any obligation to back the very earliest of companies. You know, the EIS scheme overall is mainly used by individuals who want to do angel investing. Actually, a very small proportion of EIS funds raised each year, which is north of 2 billion, about 240 million is actually invested by professional fund managers under EIS. And there's probably 5 or 6 who are of any scale. So again, just because someone has the EIS funds available doesn't mean that they definitively want to invest in the earliest stage of businesses. Sometimes the best thing to do if you are very, very early is go to specific pre-seed funds who specifically want to invest in pre-revenue businesses, or do a friends and family or angel round where people can utilize EIS as private investors. But again, EIS is a broad church. Just because someone raises money from EIS doesn't mean they have any obligation to invest in the very earliest stage of businesses. It comes down to what their investment criteria is and what they believe, how they believe is the best way of getting a return for their investors and backing businesses in which they are able to add value and help them build the best business they can.
Thanks, David. We are completely out of time. In fact, we're over time. If we were on the BBC, we would have delayed the 9 o'clock news, but I think it was worth it because we've had a brilliant conversation. Huge panel, but a really diverse and really interesting panel. I think we should do this again sometime. I think this has been a really good debate. We could do more of it. It only remains to thank David Foreman, John McKinley, David Horn, Sarah Fox, Jason Helgeson, Mark Molnar, Mona Hyatt, Elliot Angus, Himanshu Kataria, Romano Toscano and Heather Ann Hubble, and that just gives you an idea how big the panel was. I've been Steve Gardner. This has been a brilliant debate. Join us again for the next Healthcare World Series event. Thanks again to everybody, and we'll see you soon. Thanks. Bye-bye.